Okay, guys, sound check. Let me just see if this is working. Yeah, I see that, okay, there's, at least the dial's moving, so there should be audio. Anyway, folks, good morning. Welcome to another London Open, but, okay, I'm gonna put a big but here. The big but is that today is Easter Monday, which means that it's a holiday throughout most of Europe, most of the Christian world. So, which countries are on a holiday today? Let's take a look. And we've got the UK, Italy, Germany, France. Even your New Zealand and Australian markets were closed earlier, which accounts for the lack of liquidity. But that lack of liquidity did not really hold the market back during the Asian session. Or another way of looking at it is because there was a lack of liquidity, it was easier for some people to move the market. Why do I say this? Well, folks, before we talk about anything else, let's just take a quick look at an across-the-board view of the market, especially the currencies. And what do we have for today? You have a dollar dumping across the board. Okay, so the combination of the absence of the Australian, New Zealand market, along with the fears about what the impact of what President Trump is doing, has led us to a low volume rally, or should we say low volume dollar dumping. So where do we find ourselves now as far as the different markets are concerned? Because of the fear that Trump's activities could impact the long-term status of the dollar as the world's reserve currency, you've got people starting to talk about maybe repricing the US dollar. And of course, the market has reacted to this with today's open. You see your euro pushing through last week's highs. You see cable seeing highs, Australian dollar seeing highs, your gold prices seeing new historical highs, and dollar yen easing further. Okay, we're now looking at potentially pushing under 114 dollar yen over the next few days. And if you look at the dollar index, look at this. In fact, let's look at the dollar index as far as what's happened since Trump got elected. Big sell-off, and we're seeing a follow-through to that big sell-off in the dollar index. So, as we noted, we don't really have UK traders today. We have most of the bigger European markets closed today. So that limits the liquidity that there is in the market. And what does that mean for us if liquidity is not there with the current spike up, with the current rally? To me, it suggests that this could be a chart, your euro, your cable, your Aussie, these could be charts that would be vulnerable once liquidity comes in later. Okay, so let's work with that idea. Lack of liquidity and what would be the impact once liquidity comes in later during New York session. But before we go into specifics, let's see what is there in store for us this week. Let's take a look at the calendar. Anything that we should be taking note of? Alright, guys. Mhm. Looks like as far as US data is concerned, The only key numbers for us will be coming out on Thursday. You have your manufacturing, sorry, will be coming out on Wednesday when you have your manufacturing PMI data. But even then, those are flash manufacturing data, meaning they're not the final numbers, they're the initial numbers. So, no big market moving event as far as the calendar is concerned, with at least for the US dollar. Elsewhere, maybe an active week as far as your UK is concerned. You've got retail sales coming out of the UK on Friday. You also have flash PMI numbers out of the UK on Wednesday. But of course, today, the UK market is closed. So, if we don't have a big market moving event, I tend to think that market will likely respect whatever the charts are showing us. I tend to think that the current market structure is likely to persist, likely to continue, absent any big catalyst for prices to do anything else. So on that note, let's take a look at individual charts. And as usual, although I don't think I'll be able to trade anything today, let's still start with our euro. So where do we find ourselves in euro? Last week we were talking about euro likely pushing towards this previous resistance level, previous support level, about the 1500 level. What's with 1500? Not only is that a chart point, okay? See that that's a consolidation resistance from, no, this is actually weekly chart. So this is from January back in 2022. It also served as a consolidation support back in 2021. But 1500 is also a psychological level. Remember, in the markets, whenever you talk about thousands and half of that, 500s, those are typically seen as psychological price points. So where do we find ourselves now? Working rate is actually at 1510. So we're actually above that weekly scale resistance level. Is there anything immediate that we can do with our euro? Again, as we said earlier, one of the problems that we have with euro is that not only do we have a holiday out of Europe, but we've had that very spirited bullish start for the week. Okay, so if I look at the chart, I find myself, all right, we are at the supposed resistance level. Will we, I guess the big question for me is, will we hold above that 1500 area? Okay, will we hold above it, or will we end up with something that says initial test of 1500 failed, let's pull back a bit. Let's see if what the charts are telling us. Can we expect some form of pullback? Now, we noted that 1500 is a psychological resistance level. Indicator-wise, I look at the higher time frames, and the indicators are telling me this is you have a bullish trend. You have a bullish breakout of a pennant pattern. Where's your pennant pattern? Here's your pennant pattern. There's your pennant. There's your pole. Technically, we should be now thinking about getting towards the 1800 level. Okay, measure the size of the pole, project it at the breakout point, and that's the target of your pennant breakout. So bullish breakout of a pennant, but what can I do immediately? Well, let's consider our ranges. What is the ATR, or what's the average true range of your EUR USD? And well, average true range of euro is about 1348 or 134 pips. So 134 pips. Low for today is at 1383. High for today is at 1534. So I would say that you've actually seen average daily ranges already in your euro. Okay, so not really something that I like. Normally, I'd want to have um, as little price action before the open of Europe so that I could just jump any breakout that happens. Well, I'm not really in a mood to jump anything right now because, as we said, you have most of the European markets closed. So what do we have? Lower time frames, we've been overbought in our hourly charts, and we're not actually easing off that overbought level. You're actually poised for a bearish crossover, but you look at your consolidation, and what do you have? You're still inside this consolidation. So low for the day is at 1383, and I think a break of 1383 could potentially be a signal for me that okay, uh, you don't have liquidity at the moment. That rally that you've had did not have, again, you didn't have liquidity behind the rally. So if you introduce liquidity to the market, it's possible that that would dampen any of the previous bullish sentiment. It's possible that that could trigger a bearish breakout for me. But I'm not gonna, again, we're not gonna jump into anything right now given the absence of European traders. Okay, let's draw some fibs with respect to today's rally. What kind of Fibonacci retracements can we somehow expect? You know, we haven't even seen 38 point of Fib retracement with this consolidation. We're talking 1478 would be your immediate pullback target. Okay, what I find bad at this point is if I'm going to take a bearish breakout, which would give me, or which would have me looking at a push under 1500, I will have 38 point of Fib retracement immediately at 1478. So not a very good risk reward. So if I'm hesitant about joining any bearish breakout of our range play for the previous couple of hours, can I get something that says, okay, your bullish momentum is true, it's something that we can short already? Another option for me would be, okay, what if once liquidity open, once US markets open and we have liquidity, we find ourselves with these kinds of candles, shooting stars, gravestone dojis, right around the day's highs. Remember, we do not have catalyst today. It's a big holiday in Europe today. So any breakout that happens or any rally that we've seen is not supported by volume. And if there's no volume, that makes your price action vulnerable. That makes you at risk of a pullback. So what am I saying? I'm saying that, again, I'm not going to take any immediate action, but you give me prices coming from the day's highs around 1534, anything from there that says bullish momentum is over, basically a shooting star or a gravestone doji like this, then to me that says, okay, it's time for me to short. What about the idea of shorting at the break of 1500? Um, well, my issue with using a break of your consolidation low is the absence of traders to generate some follow through. So no, the only place I'm willing to sell would be with clear signals that says bullish momentum is done and this market is now dropping. Absent shooting star, absent dragonfly doji, anything else that could get me to sell this. Perhaps if I end up with something like a bearish engulfing that breaks 1500, then yeah, a bearish engulfing candle that closes below the 1500 area to me would be a good excuse to initially look for 38.2 fib retracement, look for 1478, and potentially I'd really love to see a pullback all the way down to your 1441 level. I might even consider buying once I see prices coming off that area. So for now, folks, we don't have any immediate trade in euro. I would not suggest that anyone trade our euro for now, given that European markets are closed. You don't have liquidity to drive this market. What if there's a bullish breakout? If there is a bullish breakout, I would caution people about chasing it. The only place that I would consider buying is from 61.8 fib retracement around your 1441 level. Yeah, give me hammers or shooting stars or even just a high wave doji from that retracement level, and yes, I can buy from there, but not at the break of the highs, given the extent of price action that we have seen already. So for now, folks, um, no immediate trades. We are at risk of a pullback, but it would take engulfing candles for me to use a break of your earlier consolidation lows, a break of 1500 as an excuse to jump short. Without engulfing candles, I wouldn't be too happy about taking action. I wouldn't be too excited about doing anything. Let's take a look at gold. Yeah, let me just drag. Okay, let me just switch to gold, folks. Okay, what do we have for gold, guys? So we were looking at gold before and we said that, hey, gold is at historical highs. And we said that, you know, absent any reference point, we have to use Fibonacci's to come up with targets, and we did that. We said that this rally here, sorry, let me just do the retracements first. Where are the Fibonacci tools? So we said that, okay, let's try to check if we have had a decent Fibonacci retracement in gold, and we did. Okay, for this rally from March, we pulled back to 61.8 fib retracement level, and then we said, okay, given that, we can now use our Fibonacci expansions to come up with our upside targets for gold. So where are we with this? Well, you know what? You've actually seen 100% already of your price swing from March, and we just blew past it. So what should we be thinking of in terms of gold's target now? Well, guys, you have your 61.8, 161.8 fib expansion level around 34.98. That's just $2 below 3,500. So I would say ultimately gold would be looking at this area, 3,500 psychological price point, just around your 161.8 fib expansion level. Are there other fib expansion levels? Well, there are actually more aggressive values for fib expansion. Let's see where they are. Wait, give me a sec here, guys. So where is our 1.236 fib expansion area? Well, we've actually seen that already from last Friday. We tested that. We got rejected, and now we pushed through today. Let's see your 1.382 level. Okay, so I guess our immediate target for gold would be your 13 or 34.19 area, 138.2 fib expansion level. At this point, is it something that you can buy into? Remember, gold is not like forex. Gold is traded everywhere. Okay, there's no cycle, or there's no specific geographic location where gold's volumes tend to go up, which means that despite your holiday in the UK, despite the holiday in Europe, gold still being traded in Hong Kong, in Dubai, in Mumbai, okay, and then later in the US. So I am not as concerned about the lack of liquidity with respect to gold trading as I was with respect to the euro. So looking at the charts, I guess the question would be, can I jump into gold now? Yeah, that's really always the question. Is it something that we should be trading already, or should we be waiting? Okay, you know what? Let's take a look at this. So upswing during the open, ongoing bullish breakout. We do not have UK market, we do not have European market. So it would likely be a slow grind as far as your gold's rally is concerned from this point. If you do jump in, you have all the excuse to do so Nothing in the chart, okay? Nothing in your candles for the last 3 hours that says we don't have momentum. You're seeing a decent body size. If you look at your candlesticks for the last 2 hours, almost no wick or tail. Again, very small wick or tail. So that kind of these kinds of candles, okay, candlesticks like this, where you don't have a wick, you don't have a tail, tells you that basically everyone agrees that this is a bullish market. Okay, there are no contrarians in this market. So if you don't have long wicks, you'd be pretty confident that whatever trend exists will continue. It's just a question of how fast can we get to 138.2 fib expansion, 3419 level. If you're patient, if you're not trading a very high margin, then this is to me something that we can jump into. Although it may not be a 1 hour, 2 hour trade, it may be something that you'd end up holding on until, say, the open of the US market. So we are bullish in gold. We just don't have anything that says jump in now. If you do jump in now, make sure that you're aware of your risk rewards. Ideally, your stop loss for this would be below the low for this candle here, below 3370. Let's say, okay, let's just look at the math here. Working rate right now is 33.93. Your stop loss point should be below 33.70. So you're talking about $23 downside. What's your upside here? Upside is 34.19 would be your price target. Working rate 33.93. So you're talking about maybe getting a 27 pip upside, a $27 upside for a $23 downside. Not a very great risk reward, but you're still riding the trend. So if you have to do something immediately, then yes, this is a buy for you. Although I will always prefer getting hammers coming from a support level before going long, given that we cannot count on liquidity from Europe to come in and give this a push. So safest course of action is to try to buy this from around 33.70. Look for hammers or dragonfly dojis from that area. Absent these kinds of candles here, yeah, you can buy, but it's not a very great risk reward at this point. You'll still end up likely winning. It's just not that great of, well, again, risk rewards wise, it's not that great. Alright folks, now let's take a look at something else. So holiday hit markets, I'm not going to be doing any trades, I guess. This is interesting. Let's look at equities. So what do we know? Over the past couple of days, there's been an increase, there was an increase in conversation about how maybe some people inside the Trump administration were gaming the stock market. Trump caused a 4 trillion loss in global equities, and there's been a lot of talk that some people managed to make some billions while everyone else was losing money. So how does that impact us? Well, it doesn't really impact our decision-making process, but we have to be aware of just how fishy things are right now. That said, let's take a look at our Dow. So where is Dow? Let me act as if I'm a common I'm the usual analyst. A usual analyst will have 200 simple moving average in his chart. I just want to see where we are with respect to that 200 simple moving average. Not because I use it myself, but because everybody uses it. We are way below the 200 SMA. Well, this is a weekly chart. Big sell-off. Looks like the big sell-off east all the way back to the highs from 2021. You also had the markets pull back to those highs from 2021 before. So that's about 36,976. Well, guys, you know what? I look at this chart and nothing here is telling me that this is not going to sell off. You've had that brief bounce before, and Trump was very happy when that happened. He said that he, with just his word, he was able to cause a $1 trillion recovery in global financial markets. So what do we do here? Um, let's face it, guys. Without clear direction, there is no way for me to anticipate an equity rally in the US anytime soon. Okay, that's not something that we should be watching out for, given given the mercurial nature of Trump's decision-making process. And investors do not like uncertainty. Investors want to be able to predict what's going to happen next. They want to have some methodology. It may be wrong, but these methodologies create reference points for the decision-making process. Absent that, it's just like being in the middle of the storm and trying to find it's like trying to find your way in the middle of an open field, in the middle of the night, in the middle of a storm. How do you find direction? You can't. So under the way the US is being driven right now, this is being run right now, there's just no way of knowing what's going to happen next. So absent that, I think that equities in the US will remain vulnerable. If you're thinking of shorting this, I would say, why not? Look for a test of that 36.9, what's that? 36,976 level. We've been there before. That shouldn't be much of an issue trying to get there. Nothing in the candlesticks tells me that this is ready to rally. Sure, you've had a piercing pattern here, but that piercing pattern was a one-off. That piercing pattern, normally something like this, I'd be very happy to see. Something like this kind of candlestick combination, that normally would have me thinking this is going to be bullish. But again, it's not about the charts right now as far as equities are concerned. It's about what's going to come out of Mr. Trump's mouth next. And uncertainty would likely keep long-term investors away, and short-term investors are thinking this is a very vulnerable chart. You've had double top reversals in the dailies. Again, no good news to expect out of the US anytime soon. So no immediate action, but we should be looking for a further sell-off today. We should be looking for the 36,976 area, basically 37,000 level in our DJIA. So no immediate action, folks. Bearish bias as far as U.S. equities are concerned. Now, guys, really, there's no, again, absent the European markets. I don't see myself taking any trades at this point. So we'll be cutting things a little short by a couple of minutes. Uh, I hope to see you on Wednesday. Again, this week we don't have much as far as the calendar is concerned, so likely we are just going to continue with the existing trends, which means that we should just focus more on opportunities to dump the US dollar whenever a dollar recovery happens. So, folks, thank you for joining, and I will see you on Wednesday.